Well, hello, everyone. Welcome back to our What Works series that provides practical advice from our consultants here at Eckerson Group. We've been doing these fun sessions every Friday afternoon as a way to ease you into the weekend. And this is our last session of the series until we come back in the wintertime. And up today is Rich Fox, our CDAO on staff. And we're eager to hear from him how to put business first to become a data-driven leader. But just first, a little background on the What Works series. These are really conversations between me and our consultants, which I have anyway, and we decided to open these up to the public and bring you in on the conversation. So we highly encourage you to put your comments and questions into the Q&A tab, and we will inject those into the conversation as we go along. And it's just a ton of fun, and we're all learning from each other. And I just find this so beneficial. We'll continue to do it. Beneficial for my own purposes as well as hopefully yours. Just a little bit about us at Eckerson Group. I think a lot of people know us from our research because it's freely available out there. But we do have a consulting group, and data and analytics is all we do. And we're a bunch of senior guys with gray hair or no hair. And we've been doing this a long time. And we think some of our strongest capabilities are our ability to listen, synthesize, and collaborate with our clients. These are the old guys. We are working on female in there, so don't worry if that's an issue for you. These are the areas that we consult with or on typically. And these are some of the clients that we've had in the last couple of years. So as you can see, big and small, brand name and not, focusing on all those areas that we talked about a lot these days on data governance, modernizing your data architecture, and building a full-fledged data strategy from soup to nuts. So with that, let me introduce Rich Fox. We are very lucky to have him on our team. He's been a chief analytics officer at several companies, spanning a 25-year career in this field. But he didn't start in this field. He started as a CFO. Well, started as an accountant and then a CFO at several companies. He then discovered analytics, and it's been a wonderful ride ever since. I'll let Rich, you talk more about that. He's also teaching about analytics at San Diego State University, and he created the American Institute of CPA's Data-Driven Leader Certificate program. So he is well steeped in how to use data to run a data-driven organization. So Rich, without further ado, I will turn it over to you.
Thanks, Wayne, and it's great to be here. And yes, I did start in finance and accounting, though I like to say that 25 years ago, I discovered accounting was too exciting, so I went into data and analytics. And I've even said that at accounting conferences, and the accountants find it funny, so sort of fun. But it's great to be here today and talking about a very important topic and one of my favorite topics. And Wayne talked about the What Works series, and we've talked about data architecture and data governance and self-service and data literacy, and those are all critically important because without data and good governed data, you can't do anything. But it's called business analytics for a reason. It's for the business. So here's a definition for analytics. And you'll notice it doesn't talk about creating a bunch of dashboards or reports or gathering lots of data or building lake houses or warehouses. It's about solving business problems and helping the company and the organization make faster, more effective business decisions. So when a business person or an end user comes to us and asks for a dashboard, many times they don't want a dashboard. They want answers. They want to understand their business. They ask for a dashboard because they don't know what else to ask for, or they already have some dashboards, but it's not giving them the answers that they're looking for. So they're asking for more dashboards, and they'll just keep asking for more dashboards. And that's why in most organizations, there are a very large number of dashboards that are used for a while and then never used again. And they're just out there and they become shelfware. So we're going to be talking about today, how can you build analytical solutions to help your business better and to help your end users and the business people in the company understand their business better and drive business performance forward.
So Rich, when I look at this statement here on the screen, I'm thinking, well, this is like motherhood and apple pie. Don't we all know this? And I think most data professionals, most analytics professionals do know this, but I think it's just so easy to lose sight of it and get down the rabbit hole of technology and like, okay, what kind of dashboard do you want? As opposed to thinking, well, what problem are you trying to solve, right? How can we lose sight of this very basic fundamental principle that drives what should be driving what we do?
Yeah, no, that's a great point, and I think you hit it right on the head. Is that we all know this internally, but many times we lose sight of this. And I think there's just so much data today, which on the one hand is great because it allows us to do more things. But on the other hand, it's so easy to just get lost in the data and to come from a data centric perspective without really applying it to the business. And then, even in large organizations with large teams, everyone is stretched trying to get a lot of things done. And a lot of times, there's not enough time to go and work closely with the business to really understand what are they trying to accomplish. And we'll talk about it during the webinar today, that all of this needs to be connected back to the company's business strategy. And when I work with the end users, not only do I want to understand, well, what business questions are you trying to answer, but I want to know, how does this relate to your department's strategy and initiatives for the year and your KPIs? And then how does that relate to the enterprise strategy and initiatives and enterprise KPIs for the year?
All right, you got me excited because again, another motherhood and apple pie thing that we hear is, your data strategy should align with your business strategy. And everyone knows that. Everyone says that, but I don't think anyone knows how to do that. And I know when we go into organizations and consult, it's a struggle to even get them to tell us what the business strategy is, or give us access to the executives who might know, so that we can link the two together. But I'm so eager to hear what you have to say. So let's move on to the next slide. And folks, if you're out there listening and you have a comment or a question, just put it in the Q&A module and we'll inject it into the conversation. So let's see, there we go.
So not only is analytics asking three questions, but most business people and end users have three questions relating to data and information. We all want to know how the company or organization is performing. How are we doing? The next one is, we want to understand the why. What is the root cause? And then the third thing, well, what should we be doing to improve performance? And of those three, the why is the most important, because until you understand the root cause of why something is happening, you can't make a decision to improve performance. And if you go to any quarterly board meeting and the financial results are being presented and sales are up or down, margins are up or down, profit, EBITDA is up or down, the first question the board asked is why? Why are things either performing better than we expected? And then how can we do more of that to make it even better? One of the CEOs I worked for used to like to say, how high is high? Or if we're not hitting our budget or annual plan, what is causing that? What's the root cause of that? And how can we fix it? Because all organizations are course correcting during the year to hit their annual plan or budget, because no organization hits the annual budget every month right on. So you're constantly course correcting. But unless you know the root cause of why you're not hitting the plan or performing up to expectations, it's difficult to make the decision and take action to improve performance.
I probably needed to write a sequel to my performance dashboard book, because the way I described dashboards was, monitor, analyze, and drill to detail. It did not, the dashboards then did not have a statement why, this KPI turned red or yellow. It provided the information that you could find out, but it didn't state why. And that's really what the business wants. I think that's what you're saying. And
exactly, the
yeah,
business wants to understand the why.
and there was a company I worked with, and they had dashboards, and it was a healthcare insurance company. And whenever the KPIs turned red, everyone ran around with their head cut off, trying to figure out what happened. why it happened, right? And figure out the root cause. And they realized they were just reacting to events instead of being proactive in addressing issues before they even got out of control. So they ended up using machine learning and artificial intelligence to create predictors of issues. And that enabled them to get out in front of their business and run it in a much more efficient and effective way. And the lift on their core KPIs went through the roof as a result. So I think that what your slide here kind of shows not only the questions that business asks, but also the maturity of the analytics foundation that supports those questions. And that when we start out, we do just monitoring dashboards. And then we not only provide the tools to do analysis, we provide the analysis within the dashboards. And then ideally, we're predicting what's going to happen before it even does, and offering prescriptions or remedies at the same time. So we go from reactive to proactive.
Exactly.
Do you agree?
Yes, exactly. As the organization matures in their analytics area and their analytics strategy and their framework, they get more sophisticated. And the ultimate goal is to get into the machine learning and AI and to be more predictive and prescriptive. But maybe as AI gets better and better, it will make it easier for companies. But currently, in most organizations, there's just not enough time and resources to run ML models on everything.
Yeah.
And that's why just building analytical solutions and dashboards that include root cause analysis can help the end user so significantly.
Yeah. So we're going to see some examples of that. So Rich, your mic seems to be coming in and out a tad. Maybe you could check it or get it closer to you.
Okay.
And I think this next slide kind of is a good segue from what we were just talking about.
Yeah. So top performing companies connect, and when you were just bringing up, everybody wants to know, how do you connect your data and analytics strategy to the overall business strategy? So one of the ways to do that, and what top performing companies do, is to connect your business strategy to the financial metrics in your company. And most KPIs are financial metrics. And financial metrics are just simply metrics that are in the financial statements, mainly in the income statement, but also in organizations, you'll have metrics from the balance sheet and maybe even the statement of cash flows, but usually not. But some from the balance sheet, but mainly from the income statement or the P&L. But then what's really important to be able to understand the root cause and the cause and effect of what's driving your KPIs and financial metrics is to connect the operational drivers to those financial metrics. And the thing that we all want to understand and all business people want to understand is the who, what, why, and where the why is the most important. So this is usually referred to as KPI driver models. And the next slide will be an example. And then I'm going to take you through numerous use cases. When I attend a webinar or training, I like to learn something today that I can use tomorrow in the office. So I've got use cases from actual projects and actual companies to give you an idea of what does this really look like in a company.
So we got a question, and I think you're in the process of answering it. And it's where would you actually start looking at the whys? So I think we'll start to answer that, right?
Yeah, this is a good example. So as we decompose the drivers in a company, we always start with KPIs. Every company that you talk to, and just make sure KPIs is key performance indicators. All companies have KPIs. And in fact, in many companies, they have too many KPIs because you can only track and manage so many things. And the problem, though, is that when the KPIs are not performing like they expected, they have difficulty answering the why question and understanding the root cause. And that's because they haven't connected to the drivers, the operational drivers, like we discussed on the prior slide. And typically, I will go 3 layers down. So I will identify the primary, secondary, and tertiary drivers. And I typically don't go more than 3 levels because you start to lose the business people. So to look at it at an example, all companies want to grow revenue, every single one. So we're going to use that as our example. So if revenue growth is our KPI, a set of primary drivers would be transactions and orders, your average order value, promotions and discounts. And all companies are somewhat similar no matter what industry that they're in. Most for-profit organizations, if not all, sell a product or a service, and they have transactions or orders. And each order has a value called average order value in e-commerce. It's called other things in other industries. So a lot of times the primary drivers in for a KPIs for revenue growth is going to be somewhat similar, even industry to industry. Where it gets more interesting is where you get into the secondary and tertiary drivers. So secondary drivers might be something like marketing effectiveness, ROAS or roaming. So return on advertising spend or return on marketing investment. Those two terms are used interchangeably in companies. It's essentially the same calculation. Or like on-time delivery. And then the drive down into tertiary drivers, it might be customer lifetime value, customer frequency, or customer overall satisfaction. So notice that the lower we go in the driver tree, it provides more line of sight into what's happening to the KPI, and they become more actionable. Because if you go into a company and you tell marketing or operations, I want you to increase transactions, typically the first thing they're going to say is, well, how do you want me to do that? But if you go in there and you ask them, we need to improve on time delivery, we need to improve customer overall satisfaction, those things are more actionable. The other thing that I've come across often is most times the business people and the end users know their primary drivers and maybe even the secondary drivers, but not necessarily the tertiary drivers. And like we've been discussing, the further you go down in the driver tree, they become more actionable. So it's really important to get down to 3 levels, as well as the order that they're in. And not only do you design this driver tree by working with the business and your end users, but also doing some statistical analysis and maybe even machine learning models to validate that something is a driver of a KPI. Because I have found many times that the business thinks something is a driver, but after we do some analysis, we determine that it's actually not a driver. Or there's drivers in the company that they are not aware of that are impacting it. And that's the unique position that the analytics team is in, because the marketing team, they know marketing really well, but they don't know a lot about operations or supply chain and vice versa. We are in the unique position. We work with all the different departments, and we have a better idea of how things in one functional area are impacting performance in another functional area. And I've got an example of that coming up.
Okay, let's stop for a second here. A couple things. I want to ask you about KPIs, right? So KPI is the key performance indicator, which is basically a metric, but since it's key, there probably shouldn't be that many of them, right? I mean, do you have a definition for KPIs versus just plain old metrics?
Yeah, great question. So a KPI, so there's a lot of measures in a company. And I learned years ago that the KPIs are at an enterprise level, and there should be no more than about 25 of them, even in very large organizations. Once again, there's only so much you could track and manage.
So 25 across the entire organization, which probably means that each department is going to generate 2 or 3.
Well, so that's where it gets interesting too. At the department level, they might have department level KPIs, but at the enterprise level, there should just be about 25. And also at the department level, you shouldn't have that many because once again, you can only track or manage so many.
I
But at
guess
a
what I'm saying
department,
is that sometimes organizations to create those enterprise KPIs, they're selecting one or two from each of the business domains to make, to filter or to filter them up for executive level viewing. But maybe
yeah, that is one way to do it. But the better way to do it is actually a top down and bottom up. Is to start with your business strategy and based on your business. So all companies have a multi-year business strategy and they have an annual plan. In the annual plan, there are initiatives to execute on the annual plan. Out of the strategy, annual plan, and initiatives should come the enterprise KPIs. That's the top-down approach.
yeah,
As well as you should work with the individual departments because they have their own an annual initiatives and their own specific strategy for their functional area. And they're going to come up with what KPIs and metrics they're going to be tracking. And you should make sure that the enterprise KPIs that you design are consistent with that.
right.
So,
Or
um,
that the departmental KPIs are driving the enterprise KPIs to some degree, or some of them.
exactly, exactly.
So
And then
Rich,
the
my
other,
other comment was that this is very similar to the balanced scorecard methodology. And part of that methodology was, you needed to pick, it was basically a driver methodology, right? So you had customer view, operational view,
learning and growth,
learning and growth, and there was one other, I guess the financial.
finance.
Yeah.
Yeah,
And
there's four perspectives, which, so you bring up the balanced scorecard, which I started doing balanced scorecard consulting over 20 years ago. It's really fascinating. It was created by doctors Kaplan and Norton from Harvard in the early 90s, which at that time was really revolutionary because at that time, most analysis, we looked at historical numbers in the financial statements, and they came up with these four perspectives. And they said that 75% of your KPI should be more leading indicators and lagging indicators, where lagging indicators are typically financial metrics from the financial statements, and leading indicators around the customer perspective, operational processes, and learning and growth, which are our people. And they came up with this strategy map approach, which is a great approach to use, even if you're not following the formal balanced scorecard from Doctors Kaplan and Norton. But yeah, there's a lot of great learnings in that. And this is very consistent with that.
yeah, so the only difference well, there's probably a lot of differences, but with the balanced scorecard, by choosing those for perspectives and choosing initiatives in each perspective that drive initiatives in the perspective above it and selecting metrics to measure those, they're forcing you to diversify your drivers, right? Whereas your methodology, you're doing the same thing, but you're doing it straight from the business strategy downward. And I think maybe your approach is better. But maybe we should keep moving on and look at some real examples of this.
Okay, yeah. Let's look at some use cases. So these are from actual companies I've worked at or projects I've worked on. So this is a hotel revenue driver tree model. I built this over 10 years ago for a hotel company. And revenue growth is the KPI. And PA, so this was, we used a certain software to build the driver tree. And PA there in the light blue in the KPI stands for performance area. And then PD, SD, and TD stands for primary, secondary, and tertiary driver. So our primary drivers were customer acquisition and retention, not rocket science. But then it gets more interesting as we get into the secondary drivers. So for acquisition, it's business development and guest value proposition. And for retention, it's account management and guest experience.
Hmm.
Those are actionable. But when you get into the tertiary drivers, these become much more actionable because you get into things like demand generation, sales effectiveness, guest value, hotel competitiveness, bookings pipeline, those types of things. And then if we drill into customer retention, which is on the next slide, we now have attached or connected metrics to each of the drivers. So it's typically at this point, a student asks, So what is a driver? Is it a business process or initiative, or is it a metric? And it's both.
Yeah.
Now, in most companies, when you meet with the business and you start talking about drivers for a KPI they're responsible for, many times they will start giving you metrics as opposed to business drivers or business processes. And that's perfectly fine. I've built a lot of driver trees with just metrics, but best practices is to identify the business drivers slash processes and then to map metrics to that because you need a way to measure performance, and that's why we use metrics. So here we've attached metrics to each one of those business drivers that we identified in meeting with the business. And if you're
Oh,
interested in the middle there, sorry, Wayne, in the middle there, a lot of people always ask RevPAR, what is RevPAR? So RevPAR in hotel companies is the North Star. It is the most important KPI that stands for revenue per available room. So if you look at any quarter releases of any hotel company like Marriott, they will talk about RevPAR extensively because everything flows from RevPAR because RevPAR is a calculation of a lot of other different metrics.
yeah, how well you're doing. How many people are staying at your hotel?
Well,
Um,
and not only how many people, so occupancy obviously is a very important metric in hotels, but also what is their total spend? So not only does that take into consideration the room rate, which is referred to as ADR, average daily rate in hotels, but also what else are they spending while they're at the property? And that's the beauty of RevPAR.
yeah, yeah. Now, Rich, this was an old use case here. How did it turn out in reality? Did this impact the business in any way? Can you recall?
Absolutely. And it's funny you should ask that. So if the business came to us in this company and said, we need a customer retention dashboard, we're looking at it right now. We're looking at the different layers of the driver tree and what metrics we're going to build out into the dashboard.
Mm,
So they used the driver tree, and I drilled into customer retention, but customer acquisition had a similar driver tree to build out analytical solutions and dashboards for the business. And
yeah.
that really drove how they built things. And the beauty of doing something like this, not only does it give everybody an understanding of what's important to drive overall performance in the organization, but then you're not scrambling every time the business wants something new because you've already documented all the important drivers of revenue growth, which is so important in all companies.
Did you find that the departments also use this to figure out what they should be tracking in their areas as well?
Well, absolutely, because we use this as a basis to build dashboards as well as when they were, the thing is that when a company does, typically the multi-year business strategy is updated annually, and then the annual plan is done and the initiatives. And the initiatives are not only at the enterprise level, but they're at the department level. But they typically don't get down into the tactics. So, how are the people in the individual departments going to actually act? And what are they going to specifically do to execute on the strategy and the plan? And this helped design the tactics as well as how were we going to measure success.
All right, let's keep moving on. This is great stuff.
So here's another driver tree that related to a customer 360 I built at an amusement park company. And of course, our two main drivers were to grow revenues and improve margins. Now, in many companies, when you're trying to grow revenue, you're going to do that maybe through promotions or discounts, which degrade margins. But our goal was not only to keep margins flat, but to actually improve margins. And that is one of the beauties of the customer 360 that if you think about it, customers are the growth engine of all companies. And the more you understand your customer, the better you can drive profitable revenue. So then the secondary drivers are things like optimize customer lifetime value, then customer acquisition retention and improve customer engagement. those are not necessarily that actionable, but when we get into the third level there, those become much more actionable. Things like increase share of wallet, improve cross-selling and upselling, grow the customer base. And then down there at the bottom, we've got optimized labor. Now, I get questions sometimes, wait a minute, this is a customer 360 analytical solution and driver tree. What is labor doing on this customer driver tree? Well, labor in a hospitality company is very interesting because it's actually very highly correlated to customer satisfaction and to revenue growth. And in the amusement park business, it's even more interesting because the lowest labor is not the right labor. The right labor is the right labor. And by that, I mean the right labor at the right time, at the right place to generate good customer engagement as well as good profitability. Because you could put a lot of people in the park so that customer satisfaction goes way up, but that's going to hurt profitability. And the challenge in an amusement park company, we all know what's the worst thing about going to an amusement park company? It's the lines. And this company struggled with that too in the high season. So the interesting thing about the labor, and the reason why I pointed out, is that marketing wanted the customer 360. And we worked with them to design the driver tree. And they were not thinking that optimized labor should be in the driver tree. But because we had an overall understanding of the business, we were the ones that said, no, this is actually really important. And it's actually one of the highest correlated metrics to revenue growth of all the metrics in a hospitality company.
So by optimized labor, you mean getting the right people in the roles so that they're not only good at what they do, but they're good at working with customers and being nice and helping them if they have
Well, it's
questions.
also the right labor at the right time in the right place.
Okay, so
So
scheduling.
amusement parks are very large, and I mean the parks that this company owned, they weren't nearly as big as Disneyland or Disney World, but they are still quite sizable. And we did a lot of that. In fact, it was our POS. The parks were cashless, and you had to purchase a card to be able to do anything in the park. So it was sort of like Vegas with a player's card, and our POS captured every swipe. So we had down to the second everything every customer was doing in the park. So we did a lot of customer journey mapping, understanding where the bottlenecks were during the day and what days of the week so that we could help operations manage labor and schedule labor better, as
Okay,
well as improve customer engagement and satisfaction.
got it. So it's as much scheduling as it is training and hiring. Yeah.
Oh, it's all the above.
Okay. All right, let's keep moving on here. This is wonderful stuff, Rich. And folks, if you have any questions or comments, please send them in.
So this next one is another driver tree, but from a CFO perspective. And all CFOs, their main goal is to enhance shareholder value. Not only if you're public, because typically your stock price is going to be based on shareholder value and the value of the organization, but even in private organizations, because if you're owned by a private equity firm, a PE firm, their goal is to not own you forever, but to sell you over a period of time. And the sales price is going to be based on a multiple of shareholder value. And all CFOs, like everybody else, they're very interested in growing revenues and improving margins. Those are two of the most important metrics on any income statement. But also, what's very important to them is to manage capital effectively. And there's two types of capital in all company: fixed capital, which is like buildings, plant and equipment, machinery, and whatnot, and then working capital, which is cash, accounts payable, which is AP, accounts receivable, which is AR, and then inventory. And actually, inventory has been very interesting in the last few years, thanks to COVID, because of all the supply chain disruptions. Inventory was a huge issue. And then, as people were purchasing so many goods because we were all stuck at home, stores were having to stock up on that. But then, as that switched and economies and countries started to reopen, there was all this pent up demand for travel and vacations and restaurants. and people started to spend a lot more time on services. So Target and Walmart, Macy's, and other retailers got stuck with a lot of inventory. And the way that you move that inventory is you discount it, which hurts margins. So it's very interesting what's happened these last few years. And then just like we've looked at on the other examples, we map metrics to each of these drivers in the CFO driver tree. So very similar approach to what you would build in the business area. This is what a CFO would be looking at. And this would be very closely connected with any other driver tree the business is looking at, because the CFO doesn't want to be looking at something that's not consistent with what other departments are looking at.
Right, right. Okay. Just one personal aside is that I wish companies didn't just focus on enhancing shareholder value, but would focus on other things like community value, employee satisfaction, more holistic view of what they're actually delivering to the economy as a whole. But anyway, that's a conversation for a whole different time. Oh, I recognize this.
So if any of you out there have read Wayne's performance dashboard book, and if you haven't, I strongly suggest you get it. It's one of my two favorite dashboard books. In it is the MAD or MAD approach to dashboard design. And ever since I first discovered this and read the book, I use this every week. And the next few slides will also get into how this is tied together with what we've been talking about with the driver trees. So MAD simply stands for monitor, analyze, and drill to detail. And it helps us answer business questions. So when we're monitoring performance, we want to understand how are we doing. When we get into the analysis, we want to do descriptive, diagnostic, and predictive analytics. And that's going to help us answer the what and the where and when, and then getting into the why and the root cause, and then what is likely. And then when we drill to detail, we want to know, well, what are the specifics? So if you remember one of the first slides we looked at, which talked about what are the 3 questions analytics answers, this is very closely aligned to it. And this really helps you visualize, oh, how am I going to deploy something like that to help the business answer the 3 questions? And to use an example to demonstrate how you would use a MAD approach, let's say, once again, we're tracking and we're managing revenue growth. And we drill in and we determine that there's an issue with customer retention or customer churn, or in some industries, it's called lapsing customers. So marketing wants to reactivate those churn customers or lapsed customers. So after the analysis has been done, we need a list of those customers, the customer IDs and the customer emails, and you would be able to drill down into the detail to get that list to provide that to marketing. Or even better yet, their dashboards have been built in a driver approach and a MAD approach where the marketing individual could just drill into the detail, the list of the customer IDs and the customer emails to have a marketing campaign to reactivate those customers. And then talked about how the MAD approach can be combined or connected to the driver trees and the driver model design. And it absolutely can, and they actually fit together beautifully, which I had been doing driver tree analysis and cascading KPI frameworks. And then when I came across the MAD approach in the performance dashboard book, I thought, oh, this is beautiful how these can combine together. And actually, it helps explain this to the business. And also it helps the analytics team understand how are we going to approach this. So the triangle there is the driver tree approach with the primary, secondary, and tertiary drivers. And then each of those levels match up to the MAD approach. So for the performance area, it's typically a dashboard focus. We're looking at KPIs at a high level, and we're monitoring how are we performing. In the primary and secondary performance drivers, well, we're going to do a lot of analysis to understand the why and the root cause. And the cube might be an old term going back to the OLAP days, but it's the multidimensional data models that we all build in our BI tools, no matter what BI tool that you're using. And then the tertiary drivers are getting down into the detail. So a lot of times you're looking at order level detail or transactions to understand what action is needed.
So what I was saying earlier was that maybe today we take the results of our analysis at the cube focus level and the transaction focus level, and we stick our findings back into the dashboard level. Do you see that happening at all?
Absolutely.
Okay.
I mean, so I remember years ago hearing the term forward-looking BI and embedding into dashboards results from predictive and machine learning models and combining it with just actual results to enhance the insight provided to the end user, what's going on with that KPI or that area of the business. So absolutely, and the technology has gotten so much better. The BI tools today are so much better than they were 20 years ago, that all of this is possible today, no matter what BI tool you're using.
Okay, so we're working up to actually seeing some of these dashboards, right? Okay. You want me to skip to the next one?
Yes, please.
Okay.
So the design of this approach starts with identifying cascading performance drivers and the associated metrics. So the blue diagram in the middle, which is a driver model. We're starting with shareholder value, similar to the CFO approach. And the performance areas are revenue management, expense management, and asset management. Those are all of the areas within a company from a financial perspective or financial statement perspective. And in this example, we drilled into expense management to identify performance drivers. And then we drilled into delivery performance to identify secondary drivers. So you want to identify these cascading drivers, and then what are the associated metrics that we're going to measure performance in those areas. So some key steps in doing this is you want to decompose the core drivers of value into a hierarchy of cause and effect. And it's interesting that I put the word value in here, which I use all the time. And Wayne, you brought up that you wish companies looked at more than just shareholder value. They should look at all value. And I totally agree. And actually, the balanced scorecard is a great tool to do that, because there's a lot of value in employees. I was having a conversation last night about that customer lifetime value might be the most important asset to any company, and yet it's not on the balance sheet. So there's a lot of value in a company. And that's why I use the word value there, as opposed to decompose the core drivers of profit or sales or something like that. And then the second point is to build the hierarchy down to the lowest level of decision and analytics. And like I said earlier, I typically go down 3 levels, and the business a lot of times will have trouble maybe going down 3 levels. And that's where we have to work closely with them to help them. And also statistical analysis and machine learning models can really help identify those tertiary drivers. And then the last step is to map the KPIs and metrics to the drivers to create the cascaded hierarchy and the driver tree.
So Rich, here you've got at the top shareholder value. So SV stands for shareholder value.
That's correct. And PA is performance area, PD primary driver, SV secondary driver.
So you didn't put tertiary drivers on this one, but normally you would, right? Or
it's just an example.
Yeah.
But yeah, typically you would have the tertiary drivers also.
So the primary areas, are those only related to shareholder value or other things at the same level as shareholder value, or is shareholder value the only thing at that level?
You mean the performance areas?
Yeah, I'm just wondering where we're starting here. Is shareholder value one aspect of the strategy, overall business strategy, or is that the ultimate goal of the strategy?
That
And
is the ultimate goal of the strategy, is
okay,
to enhance shareholder value.
okay, I guess I'm still
And
pushing back on that notion. So then the three primary areas are ultimately what the business strategy is focused on.
yeah, which is typically increasing revenue, managing expenses, and then managing assets.
Yeah.
And in the asset area, not only is that assets that are on the balance sheet, but that could be assets like employees and employee value and customer lifetime value.
Hmm.
So under asset management, it could be more than pure assets, accounting assets that appear on the balance sheet.
Okay. All right. Should we look at some dashboards now?
Yeah, so now I'm going to take you through actual driver-based dashboard, because a lot of times when I teach or I talk to people about this, they're like going, well, how do you actually do this? So I have built this, designed this and built this for numerous different companies. This, we're going to look here at a restaurant example, but I've also done this for a very large health gym operator in the country, as well as a very large bank in North America, a large university, amusement park company. So it works in a lot of different industries. And here we're looking at revenue growth again. So our KPI is revenue growth, and that is the metric at the left that has the dark blue background. And then the main drivers of revenue growth are to the right of it. And in a restaurant company, those are guest growth, average check growth, average check dollars, guest per check, that's the party size, and then coupon percent. And those are the main drivers that impact the revenue calculation. And they're listed in a specific order, left to right. The ones on the left are more important than the ones on the right. And then in multi-unit companies like a restaurant or a hotel or a retailer or a health gym operator, even a bank with multiple branches all over the country, is that we roll them up by area, typically by geography. So the rows there are different areas, and each of those areas have a group of restaurants underneath them. And then the areas are sorted from best revenue growth to poorest revenue growth. And notice how highly visual this is. So you can quickly identify the areas that are underperforming. Why are they underperforming? As well as you can quickly identify opportunities. So one of the things that I think that we fail sometimes in helping the business use analytical tools is to focus on underperformance and improve that. Well, there's also opportunities in areas of our business that are actually exceeding expectations or exceeding plans. So if you look at the third row there, area 2, they have the third best revenue growth, but their average check growth is actually quite negative. So what if their average check growth was as good as the other top performers? They'd probably be the number one revenue growth store. So not only does this help you understand why the underperformers are underperforming, but opportunities to improve the top performers.
So
Go
just
ahead.
going back to my book, I spent a lot of time trying to figure out the difference between a dashboard and a scorecard because there was so much confusion at the time. And I suspect there still is confusion. So when I look at this, to me, this is more of a scorecard, or actually, it's kind of a hybrid between the two.
It's a hybrid. It's not exactly a scorecard, but it's probably a hybrid between a scorecard and a dashboard. We've always called them dashboards,
Yeah.
but yeah, it's probably a hybrid between a
Yeah. We always
scorecard
say use
and a
whatever
dashboard.
terminology is comfortable with you. The scorecard was more aligned with the Balanced Scorecard Initiative by Kaplan and Norton, where you're tracking KPIs associated with initiatives driving the strategy. So this is not quite that, but it's close.
Yeah, it's sort of in that
Yeah.
direction.
I have a question from Lewis here. Why do you think methodologies like the Balanced Scorecard are less used these days and not connected to data and analytics initiatives?
Great question.
Yeah.
So Balanced scorecard approach is a wonderful approach. It's got a lot of great concepts in it. And like I said, in the early 90s, it was really revolutionary. And Kaplan and Norton went on to write numerous books about it. But to deploy it to its fullest is very costly and requires a lot of management.
Mm,
So there were a bunch of companies that did it 20 some years ago, but most of them did not stay with it just because it requires so much management and maintenance. And
mm.
then at each year, when the strategy is updated and initiatives are updated, the balanced scorecard needs to be updated, and it wasn't all that easy. 20 years ago, I was to use an old BI name, I was a Cognos Premier Partner, and I was working closely with Cognos. And I was brought into American Express because they were deploying a balanced scorecard, and they had one of the large consulting firms in there designing the balanced scorecard, and they were talking to us about software to deploy the balanced scorecard, and Cognos had balanced scorecard software. And I remember meeting with one of the team members from the large consulting firm, and he told me, "Good luck deploying this," because he says this is not going to be easy to deploy this. So I think that's why a lot of companies are not using the full blown balanced scorecard. Now, that being said, I use the thinking behind the balanced scorecard and the four perspectives and the leading versus lagging indicators all the time. Like
Yeah.
when I'm meeting with business users and looking at KPI driver trees, or trying to understand what are they really trying to answer and what are they trying to manage, I'll be thinking about a strategy map in my head, because many times in organizations, when there's an issue in an area or with a metric, it ends up involving areas of operational processes and people, which is called learning and growth in the balanced scorecard.
Yeah.
But many times the end user or business person is not thinking about that. And that's where a lot of that comes in. The restaurant company Boston Market, which was very popular years ago, they used to have an employee survey, part of their POS system. And every quarter, every employee took the survey. Well, lo and behold, they discovered that the survey was the highest correlated metric to future revenue growth. And when employee satisfaction started to decline in a restaurant, revenue almost always declined
Yeah.
weeks or 2, 3 months later. So many times we're thinking about, well, we want to increase revenue. Well, that's number of orders and average order value. And we need to do those things. And we may not be thinking about the people that are actually doing the work in the company. And
Right.
there's a reason why the strategy maps are always built in the same way. That is, learning and growth, or our people, are the bottom of the strategy map, because our people are our biggest asset and they're the foundation of every company.
Right. That is the benefit of the balanced scorecard is it forces you to think about those four perspectives separately and not
Exactly.
forget about the people and their
Yeah.
training. So we
Yeah.
have about 4 minutes left, Rich, in the
Yeah.
official
We only have
time.
a few
So
slides.
let's
So,
go through the
so
few
if you,
slides. We got one question from Sam outstanding, and anyone else, please contribute. We'll get to it. Okay.
so if you click on one of the areas on this dashboard, you drill into that area and you're looking at the same design, but now we're looking at individual stores. And then if you click on an individual store, we go to the next slide. And this is comparing a specific store to groups of stores. So, what do we do in companies? We're always comparing an area of the company to other areas. In multi unit companies, we're comparing one restaurant or one hotel or one retail location to groups of other units. In manufacturing companies or product companies, we're comparing one product line or product category to other product lines and product categories for different metrics. So here down the rows, we've got P&L metrics and then actual versus budget in this example. And we're comparing a specific restaurant to actually three groups of different restaurants. And it's not important how those groups were determined, but we compare it to three different groups to have a overall line of sight to different areas of the company. And then there towards the right, we identify what quartile this specific store is performing compared to that group that we're comparing it to. So there's three different ones. And then the trends is looking at the trailing 6-month trend. So a lot of times I'm asked, should I look at a metric at a point in time or a trend over time? And ideally, you look at both and ideally side by side, which is what this is doing. And why that's important, if we look at the first one, which is RCP percent, which stands for Restaurant Controllable Profit, the comparison to their peer quartile, they're in the first quartile. So they're a top performer. But if we look at the trend, it's negative, which means maybe in a few months, they're going to be in the second or third quartile. And if they continue trending like that, they're going to be in the bottom quartile. So looking at trends, you could think about it as an early warning signal that performance in the future may not be as good as it is today. And we need to, in managing performance in a company, we need to understand both of those.
Okay. Rich, last slide.
So some key takeaways. Like we've been talking today, we wanted to develop a comprehensive set of KPIs and metrics, and they need to be aligned to the overall enterprise business strategy. And they enable management to assess the business, identify root causes, and take action. Second, like we've been talking, you want to identify the interrelationship between your KPIs, metrics, and performance drivers to enable drill down analysis to the root cause, if it's positive or negative, because you want to understand both. And lastly, you want to extend and expand the line of sight from lagging, which are financial metrics, to leading operational metrics and monitor them, which that last point is very closely aligned to the balanced scorecard, because one of the biggest points coming out of the balanced scorecard was leading versus lagging indicators. And they recommended that 75% of the KPIs in a company should be leading versus lagging.
Is it fair to say that your driver, the metrics for your drivers, the three levels, are the leading indicators?
Yeah, most drivers are leading indicators.
Yep.
Most KPIs are lagging indicators, which come out of the financial statements. Now,
Well,
that's not always the case. In many companies, there'll be customer-related KPIs, which are not financial metrics because they're not in the financial statements. But many KPIs in a company are financial-oriented, and that's because they're so closely aligned in enhancing shareholder value. That's why a lot of KPIs are financial metrics.
Okay, so folks, that's the end of our official What Works episode here. It's as I said, it's the last episode of the winter, but don't go away. We have four questions that have come in. We'll take those questions and stay as long as you want. But we're going to put this together again in some shape or form in the winter. If you have any ideas for what you want us to cover, who you want us to interview, let me know. This is a community endeavor. All right, so Sam asks, my hypothesis is that most important KPIs / drivers in the business should probably come from key processes that integrate several departments. Do you agree? If yes, how well do you find organizations do this? So that's interesting perspective.
Yeah, I totally agree. So I was fortunate enough to work for Dr. Richard Conley years ago when I started in data and analytics. And in one of his books, one of the themes was called coordinated decision making, which means decisions need to be coordinated throughout the value chain, different departments. And even though departments might have data silos, they've got their own spreadsheets, they might have their own databases, their decisions are not made in silos because decisions in one area impact others. And many times when you're identifying the drivers will come from different areas of the company. The customer 360 from the amusement park that I showed, Labor has nothing to do with marketing. Marketing is not responsible for labor, but it ended up being one of the very important drivers in driving the customer 360 strategy. So absolutely, you will get drivers from different areas of the company that impact a KPI. And that's where you need to work with different departments to pull this together. And that's where we are in the unique position within organizations to do that, because we work with all the data in a company.
Yeah, that's a great answer. I'm wondering if Sam is actually talking about initiatives that integrate different departments. You know what I mean? It's because I think what we're talking about here is that you have different drivers that activate different parts of the organization, that they need to do what they're doing maybe in a slightly different way, not necessarily working with other groups. Like I'm thinking of the labor and optimizing labor, but there may be initiatives to actually integrate finance and operations, integrate sales and marketing. I'm just speculating here. Sam, if you want to ask another question and follow up, we'll come back to it.
Well, and yeah, if that's what he means, that it actually makes it a little bit easier, because then those other departments, they're already on board on what the initiative is. And actually, so an example of that is that many companies that, so in e-commerce, and I worked at an e-commerce business, the beauty of that from a data and analytics perspective is that you know who has purchased every order, and you have their name and address because you need to ship the order to them. And I had worked in e-commerce after working in hospitality, and I was thinking hospitality would love to have this kind of data to understand your customer better. Well, now loyalty programs have become very important. And if you look at companies like Panera Bread, Chipotle, McDonald's, and then some retailers, they're doing an excellent job at building their loyalty program. And I have friends that work at those companies, and many times driving the loyalty program is a lot more than just the marketing department, because at the store level, you want the employees engaging with customers to sign up for the loyalty program. So you get operations involved in that. And the thing is, what's very important, especially in the restaurant business, is speed of service. So then it's like a balancing act. Okay, we want our speed of service to be good, but we want our employees, like at the register, asking a customer to sign up for the loyalty program. So there's an example of an initiative that a lot of companies have today where that involves multiple departments.
Yeah, and there are a lot of those, and some of these have like names like procure to pay, right? What are some of the others there? Cash to order or order to
Yep.
cash,
Yeah.
those by nature require integration and cooperation between different domains in the business.
Yeah, exactly.
All right, let's switch gears to a question from Ram. We are seeing, this is more of a tooling question. We are seeing transition from Cognos/Click, i.e. legacy BI tools, to Tableau, Power BI, to now ThoughtSpot, NLP-based conversational analytics tools. What is your perspective if you want to rationalize the cost of these platforms and converge on one or two tools instead of multiple dashboarding tools? Okay, that's a perennial question. How do we standardize on one, if that's even possible?
Yeah, it actually, I'm working with a company right now that just purchased a company, and they've got ThoughtSpot, and the other company has Power BI, and they're trying to decide, do they want to conform on one of them? And of course, the people using ThoughtSpot like ThoughtSpot, and the Power BI people like Power BI. But what we're finding out is that ThoughtSpot's great for the casual user, but not really the power user, at least in this organization. But I think BI tools have come along so far. I mean, when I first started in the late 90s, there were no web BI products, and they were rather simple and not very sophisticated. And they have come a long, long ways. And even Power BI and Tableau are embedding things like NLP into it. And I think Tableau purchased a company called Narrative Science, where it helps do statistical analysis of whatever you're looking at. It can even do some clustering analysis. and Power BI has some great things built into it. So I think the tools are getting better and better, that it's making it easier to find one tool to conform on. And like I tell people, if today, in the old days, it was like Cognos versus business objects, a discussion. And today, you hear the Power BI versus Tableau discussion. Well, they're both in the magic quadrant. They're both excellent tools. They're slightly different. You do things slightly different in both of them. I use both of them every day. And thing is, like I tell everybody, no software does everything. I don't care what the software is in any area. And there's some things Tableau does better than Power BI and vice versa. And there's some things that like ThoughtSpot does better than the other two. So I think it's determining what's important in your organization, what functionality are the people looking for. You should. So at the Eckerson Group, we've worked with companies and helping them determine self-service strategies and data literacy plans. And the best way to approach that is to identify personas in an organization, and then what are those people's needs when it comes to data and analytics, and determine what training and literacy do they need, and matching up the tool set. And an approach like that will help you determine, okay, we're considering multiple tools, which one is going to meet the most of our needs in the best way possible.
Yeah, this is a perennial question, and like 10 years ago, we might have answered it differently than now. But I think BI has become commoditized to a large degree. Power BI and Tableau are kind of the leaders now. And, any innovation that quickly gets absorbed into those products, like augmented analytics, right? The ability to have the tool go out and do correlations behind the scene and generate new trends and predictions for you without doing any work is something that used to be done by tools separately. Now it's been brought into these big platforms. Data science is now you can build ML models and BI tools. And, I used to say casual users needed a slightly different interface. Now we've got search-based interfaces, NLP interfaces. There is one area that I'm still thinking is neat to have a best-of-breed tool, and that is a data fabric tool for your power users. It's built on a very high-performance query federation engine like Trino that can go out and find and discover data because it's got kind of like a built-in catalog. So your power users, when there's, when you've got a kind of a monolithic data environment and the warehouse and the lake are hard to get things done in, and your data is scattered everywhere, to give power users a tool where they can discover, they can query, they can prep, they can visualize all in one platform. I don't think the big guys do that well yet. They may do it soon, but not yet. And I think that's one area maybe that I think I see some differentiation in the market right now, but overall it's commoditized. Let's see what else we have here. Sam's asking, let's say there was COO or SVP of restaurants. Would you want to be writing an algorithm for them to say, here are the top 10 restaurants you might want to look into? Or is that sort of analysis best left to the regional directors who manage their stores as a group?
No, in multi-unit companies like restaurants or retailers or hotels, we build solutions to identify the top and bottom performers, and also to build root cause analysis on why are they top and bottom performers. Because one of the beauties in a multi-unit company is that if you can identify why the top performers are performing better than everyone else, many times what you learn can be applied to other units. And the same thing with the bottom performers. Once you determine things that are making them a bottom performer, well, other units might be doing similar things, just not to such a far extent, and you can fix that throughout the entire system. So we work very closely with every multi-unit company I've been at. And that's even like in health gyms and in financial institutions with branches throughout the country in North America, is that we work very closely with operations to help them identify good and poor performance, why that's happening, and what steps they can take to improve overall performance.
Okay, last question from Dan. How long does a typical engagement take? Just need to get a sense. I realize that it varies. I assume that's an engagement to put together a driver model with associated dashboards.
Yeah, so it sort of depends. Is it at an enterprise level or is it at a department level? The department will go faster. And I've put department level driver trees together in just a few days. And it also depends on how well the end users or the business person understand their area of the business, and how does it relate to identifying the drivers. At the enterprise level, it is going to take longer because you're at the enterprise level. You most definitely want to understand the overall business strategy. So over the last 25 years, I've run data and analytics teams as well as I've been a consultant. And in both roles, like when I join a company as a new employee, one of the first things I want to see is the most recent board presentation, because they're going to talk about the strategy and the most important KPIs and metrics. And I want to see what the discussion is at that level, as well as I want to see the business strategy. And typically the updated annual business strategy is presented to the board in a board meeting. And I want to see that deck to get an understanding of all of that. So then when you're working with the individual department, you can understand how does this relate or connect back to the overall enterprise strategy, which is what we're all trying to do in a business, is to drive performance against the strategy, as well as when you need to decide what are you going to work on or what are your priorities. Well, it should be which of them are going to deliver the highest ROI to achieve the strategy.
This is really good, Rich. I've actually learned a ton, even though he presented stuff of some of my own work. I think this is kind of stuff every company should be doing, and we should be helping companies do more of this. So thank you so much for your time and your insights. And thank you everyone who's still on the line for all your questions and consideration. So stay tuned when we revive this in the wintertime with a whole new slate of speakers and topics. Send us topics you would like to see us cover, and we will do our best to do that. Until then, have a great rest of your month and rest of the year. Take care. Bye.
Thank you all.